Welcome to our channel. Please like and subscribe. What if the biggest risk in your financial life isn't losing money, but putting all your money in the wrong place? Because most people think risk means volatility, prices going up and down. But real risk is something quieter, something you don't notice until it's too late. Stay with me. Because once you understand this, you'll never look at money the same way again. Let's begin. Simply, what is diversification? At its core, diversification means not putting all your eggs in one basket. But this idea goes deeper than it sounds, because diversification isn't just about having many investments. It's about having different kinds of investments that don't all react the same way. Imagine this. You invest everything into one company. If that company grows, you win. But if it fails, everything disappears. Now imagine something different. Your money is spread across multiple companies, different industries, different countries, different types of assets. If one fails, others can still succeed. And your overall loss becomes smaller. That is diversification. Not avoiding risk, but managing it intelligently. Now, here's the key idea. Not all risks are the same. There are two types: specific risk and market risk. Specific risk is tied to one company or one asset. A bad decision, a failed product, a scandal. Market risk affects everything. Economic downturns, global events, interest rate changes. Diversification can reduce specific risk, but it cannot eliminate market risk. And that's important because many people think diversification makes them safe. But it doesn't make you immune. It makes you resilient. Let's make this practical. Instead of investing in one stock, you invest in many through something like an index fund. Instead of only stocks, you also include bonds, real estate, or other asset types. Each behaves differently in different conditions. So when one falls, another may rise or fall less. This balance smooths your journey. Now here's where people get it wrong. They think diversification means owning a lot of the same thing. For example, owning 20 tech stocks is not true diversification, because if the tech sector drops, all of them drop together. Real diversification means spreading across different sectors, different markets, different risks. Another mistake: over diversification, having too many investments to the point where you lose focus and your returns become diluted. Diversification is about balance, not extremes. Now, think about this. Why do professional investors diversify? Because they understand one simple truth: you cannot predict the future. No one knows which stock will win, which market will rise, or when things will change. Diversification accepts uncertainty and prepares for it. So instead of trying to be right all the time, you build a system that works. Over time, you reduce the impact of being wrong, and that is the smart way to manage risk. Now, bring this back to your life. If all your income comes from one source, that's risk. If all your savings are in one place, that's risk. Diversification isn't just investing, it's a mindset. Spreading risk across opportunities, creating stability through variety. So start simple. Don't aim for perfection. Aim for balance. Different assets, different strategies, different sources. Because over time, diversification doesn't just protect you, it gives you confidence. Confidence to stay invested. Confidence to stay calm. Confidence to keep moving forward. Stay here for a moment. Let this idea settle. Because the smartest investors aren't the ones who take the biggest risks. They're the ones who manage risk the best. And now, slowly, gently, we begin again with what if? The biggest risk in your financial life isn't losing money. That was excellent. Please like and subscribe for daily lessons. See you next time.